And welcome back. We were talking about financial myths that can really damage your wealth. So myth number 2 is ditch that latte, because if I ditch the latte, I'll energize my wealth. So I used to go to the gas station and get the whatever was languishing in those stained pots on the hot burners, and it was all burned.
Wow, man, like you were brave.
I am. It sort of gets things going in the morning. I'm not going to go any further. Mega money celebs. So these are Susie Ormans and the Dave Ramseys. They fall over themselves with this wisdom. They want to make you feel guilty for waiting in line for coffee. So I listen. I understand. The part of it is the fact is when an Orman or a Ramsey tells you to stop the latte, they tell you that you can go ahead and put it in the market and get 11% return, which is very, very far from reality.
Oh, just invest in an international growth stock. You'll be great.
So you got to take your $2.50 or $5 from your simple daily enjoyment, and you're going to go put it into risk assets like stocks, and you're going to move your wealth needle. No, you're going to probably have a headache from caffeine withdrawal. So I'm sorry about that. So there's a great book out there. Helene Olin wrote this book called Pound Foolish, and I hate her because I wanted to write it, but she did it. And it's The Myths of Personal Finance. And it's a pretty entertaining tell-all. And she discovered this, she calls the Latte Factor, surfaced back in 1994 in a Money Magazine article.
Okay.
And it was also touted by Susie Orman in her book in 1999, The Courage to be Rich. So she talked about that this caffeine addiction and taking your money and moving it to, something else would be better. Okay, so if you have $250, say $2.50 a day, you invest it for 30 years at 4%, you'll have $52,000. Okay, that's okay. Listen, if I'm going to take that money and I'm going to go put it into something, and I don't dislike the theory or the spirit of this. Okay, but to me, what's your return on satisfaction for $3 a day? I think it's a bargain if a small purchase provides a big breather, peace of mind, a recharge, so you focus on the important tasks that make you money. So purchase the coffee and don't deprive yourself of simple pleasures. That's not the path to financial fulfillment. It's just not.
Well, and to put that, even break that down even further, what is that? So $365, just say $5, you're looking at over $1,800 a year. And if you had 5% on that, that's less than $100 a year.
Yep.
That you're going to make.
So I think the way you make more money. So my friend Amanda Steinberg, who's been a pioneer in many ways in finance industry, she has a book out called Worth It that did very well. She's a fintech leader. She has a passion to help girls and women improve. And I was in her book, and she used the mortgage rule that we created in her book, that never take on a mortgage that exceeds twice your gross income, okay? So these kinds of formulas are going to supercharge your ability to build wealth. The things we talked about in the first segment, right? Yep. About living smaller than what you bring in. That's what's going to supercharge your wealth. The return on you and what you're doing, not you stopping the $3 a day. In coffee. So just keep that in mind. So if you have these simple pleasures, don't stop them. Okay? I understand if it makes you feel good about stopping it because you feel that, or bringing your lunch, or any of those things that are going to help you on a daily basis manage your finance. If that gives you a sense of empowerment to take on the big tasks, I'm all for it. But if you think that's going to make you rich, not going to work. This is one of your favorites, Danny. Myth 3 is the rule of 72, right?
Oh, yeah. I love this one. This is great because, we get calls from time to time saying, man, I have averaged 7% over the last 10 years and it hasn't doubled or however long. And the problem with the rule of 72 is that also relies, going back to myth number 1, on compound interest.
Maybe you want to explain, too, what the rule is, because maybe our smart audience doesn't know what it is.
So essentially, the rule of 72 is a method to determine how long an investment will take to double, giving a fixed, now here's the key, fixed annual rate of return or annual rate of interest. So you divide 72 by that annual rate of return. So essentially, for easy math, I mean, you could say, you're going to have an 8% return every year. And how long is that going to take you? Was that 8 years? Yeah, some help here. 9 years. Come on, guys. So it takes you what, 9 years? And the problem is that the key word here is the fixed annual rate of return. And this is something
you find me 8%, and I'm happy to.
Oh, heck yeah!
Happy to do that for you.
But the issue, it also goes back to is that a lot of these firms, they tout this rule frequently. I hear advisors tout Rule of 72, but this does not pertain to a typical investment account because those accounts are going up and down.
Exactly. So keep this in mind. The key word here is fixed annual. Fixed, not variable. Variable is stocks. Okay? I mean, we still meet with people every day. I met with a few couples that still have enough carry forward losses from the tech bubble. That's 2000, okay? So that Rule of 72 is not working for them, okay? So the Rule of 72 should be reworked to consider how long it may take to recover from investment setbacks, okay? So I need you to ignore this rule very much so because it doesn't mean a thing unless you tell me, Rich, I only invest in CDs. I only invest in even high-quality bonds. And this is my rate, okay? Then it would work. In stocks, you have a great, tailwind, and you're very aggressive, which most investors can't do. I would say, okay, maybe I can give you a pass. But for the most part, this Rule of 72 is just dangerous, and you need to throw it out.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.